Hello, everyone. This is Casey Stubbs with Richard K, and we're here with Price Action and Income for the special member training that today Richard's going to present. Thanks, everybody, for being here today. I just want to do a quick sound check, make sure that everybody can hear me, and make sure that you guys can see everything, just so we're good to go. Thanks, everybody, so just let me know. If you guys can hear us. And also, I just want to thank everybody for being a member and for trying out our course and working with the course. We've had a lot of good feedback. We're really interested in making sure that you guys are using it well and that you understand it. And that this is really a taking the next level in our training. We've done a great job of presenting a really good course that everyone can understand. And this now we're working at improving it. We're working at taking it to the next level so that you guys can get even more value out of the course because we really value your members. And the whole purpose of it is to make sure that you guys are able to use it and understand it. So the format for today is I'm going to hand it over to Richard here, and he's going to teach. And then afterwards, I'm going to share about our forecast service. And then we're going to do a question and answer session so that any questions that you have about the content, we will answer for you. So what we're going to do now is pass it off to Richard. But if you have any questions, please just write them down, and so that we can get to them at the very end. All right. With that being said, thank you all for being here. And Richard, are you ready to go?
I'm ready to go. Thanks, Casey.
Okay. All right. Well, let's go ahead and see if we can get your screens up there so they can see what you're talking about.
There we go. Let's get my slides going.
All right. I see it.
Do you see it? Okay. Perfect. Well, thank you, everybody. Thanks for attending today's training session, and especially thanks to everyone that decided to take the plunge and actually join in the course. Like Casey said, we'll be delving a bit deeper into the second part of our strategy today, which is pretty much the actual bulk of what my methodology or strategy is all about. So I've got a few slides to share with you guys. We're going to be talking about quite a few things. Please write down any questions you have so that we can answer them afterwards. And yeah, so I hope you guys enjoy the session. So today we're going to be covering the second part of the strategy. Like we said before, to try to do everything in one go is simply going to take too long. I believe that taking small little parts and all little tips and hints that I might share with you guys along the way will be really helpful. And yeah, without further ado, let's get going. So today we're pretty much going to focus on market geometry and the entry confirmation techniques that's presented in my course. And then we're going to be focusing especially on what we call the pitchfork, which is a drawing tool that's probably been gathering dust inside your platform. Not a lot of people use it that often, but it is an extremely useful tool, especially when you apply it the way I do, and hopefully you guys will be doing in the near future. So we use market geometry such as a pitchfork to find areas or zones where corrections may end. Specifically in my strategy, we are more focused on finding where a correction might end within a trend and then find low-risk setups where that correction would hopefully go into the direction of the main trend again. And then we're going to cover how to follow a few sets of entry conditions to confirm an entry. And this is a very important part. We'll be breaking it up in a few ways that you guys can actually utilize this if you so wish. And basically the entry conditions were developed to keep you out of bad entries and basically to confirm when price is actually ready to reverse, when a certain few things happen. And then, of course, as usual, I'll be showing you guys a lot of examples afterwards. All right, let's go to the next slide. So let's quickly have a recap of what we did in strategy part 1. first thing we had to do was use simple techniques to identify trend direction. And we used such things as trend lines and uptrending and downward trending markets, or waves, as we call it, and market structure. Then we used Fibonacci extensions to determine where we're most likely to see a correction appear. And then we went into a little bit more of a complicated sort of methodology of trying to identify what corrective patterns look like and the ones that we follow. And if you guys can remember, the ones I follow mostly, and there are many more, the ones I like to focus on are the single zigzags, the double zigzags, expanded flats, and triangles. If you can remember last time that I said it's quite important for you guys to understand or try to figure out what correction you might be dealing with while the market is developing. This way you could use your pitchfork lines properly and anchor them to the correct pivots, which is a very important part in the whole process. Although you don't need to be an expert at labeling these zigzags properly, but if you've got a really good idea of what corrective patterns look like, then your pitchfork's obviously there as the second part or the filter to guide you as to where these corrections most typically would end. Next slide. All right, so let's start. First off, what is market geometry? There's a definitely underlying symmetry in price behavior, and finding ways to measure or define the symmetry using drawing tools, that is called market geometry. So market geometry is probably the only part of the course that it can be a little bit subjective in nature, but as we go along, I'll be definitely guiding you guys and showing you a few tips and tricks as to how you would know when you're actually drawing your pitchforks correctly. This is probably a question we get a lot from our members, asking like, which pivots should I have used and what can I be looking out for to know that I drew my pitchfork correctly. So we'll be looking into that a little bit later on. The pitchfork was developed by Dr. Alan H. Andrews many years back, and it was used to correctly define future price movement in both the most likely direction a market may take and where price is most likely to find support and resistance. They are particularly useful in my opinion, and as we will see later on, especially when we go over some examples, when you apply them correctly to corrections. They work extremely well on corrections, and I'll also be sharing with you which settings I use later on to define my corrections properly. Oops, jumped a little bit too far. So first off, I don't know if you guys been playing around with your pitchforks. There are two types of pitchforks, or actually three, although the third one we don't really use at all. The first one we use is what we call a standard pitchfork. And to draw a pitchfork simply, on this example here, I used gold as an example. You want to basically figure out where your most important pivots are in the market, and then use your pitchfork to show you the most likely direction that a market might take. So on the left hand side, you'll see with this red down arrow, so this was an actual high in April. I think this was last year, to give you a really good example. And basically what happened was, no, sorry, this is this year. Just to show you the power of what pitchforks can do, everyone expected gold to go here in April to the 1400s, and we had a false breakout and a reversal. Now, using that was the high of the utmost high of this year so far, and using two other pivots, it was likely you could see that we had price bouncing around within these pitchfork lines until it ended here in August, and now we've had this move that we've got up recently. Now, pitchforks got three major lines. The first one is what we call the median line, which is your center median line, also called. And then what we'll always have is an upper median line and also a lower median line. You see that we got these dotted little lines in between here as well. They basically just a 50% distance between where your center median line and your upper and your lower median lines would be. Now, if that's not enough, I also went as far as also putting what we call warning lines, which is equidistant from the center to the upper or the center to the lower, and projected below and above your upper blue median lines and lower blue median lines. And I color them red. You'll see with a high degree of accuracy that when we are dealing with actual corrections, that most of the time you'll probably find that when we use the second setting I'll show in the next slide, is that your corrections love to end at your warning lines. In this case, standard pitchforks are very useful when you actually want to define the trend. And as you can see in the bottom here that we made in August, I think it was about the 18th of August somewhere, gold reached the lower median line for the first time and the trend started changing upwards. Now, whether the trend in gold is going to continue upwards or if it's just merely a larger correction higher, no one knows. But it is just very interesting to see how price actually bounces around and respects these median lines and the 50% median lines that you have between the upper and your median line or your center median line. Now, a question that I get a lot, like I mentioned previously, is like, how would you know if you're drawing your median lines correctly? Well, the first thing to do is to actually look at price action when you've drawn your median line or your pitchfork. And you'll see a lot that price starts respecting and bouncing off your center median line. In this case is what we call vibrating around the median line. You can see it's been doing this all along down till this low we had in August here. Another good indication is to see when price starts respecting your 50% median lines, like it did over here, 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 and there. And then where did it end? When it reached the lower median line for the first time. Standard pitchforks are great tools to use in the trending market, but I don't really use them that often in the trending market because I'm mostly focused on using it in corrections. The problem is like trying to figure out where a trend might end is a very difficult thing to do, in my opinion, because trends can last for a very long time. And trying to figure out where a trend might just end, it's almost defying the purpose. So that was the standard pitchfork. The next one we have is called the shift pitchfork. Now, the shift pitchfork is actually named after one of the students, which later became a colleague of Dr. Andrews. And he proposed that rather than using, and as we can see on the picture over here, rather than actually having the median line or center median line anchored to the lower end, like we did in the previous slide, for example, he would suggest that you still use two important pivots. In this case, we used a higher high and then a higher low again, and then use the range that we have from the high here to where this correction started from, or change of a new trend, who knows, and basically pivot your center median line to 50% of what this range would be. Now, I know a lot of you guys that use MetaTrader 4 might have issues with actually getting a shift pitchfork drawn properly, but there is an actual way to just divide this range into half and then rather use the center to draw your pitchfork from, and then use a standard rather than actually using a shift pitchfork. A lot of questions I actually get about people's like, what should they do if they can't actually get a shift pitchfork on the trading platform? Well, firstly, in my opinion, I really do believe that most platforms should be giving you a shift pitchfork, and if they don't, then you should not get disheartened and just maybe try to look somewhere else. In my case, I actually have an MT4 brokerage account or use an MT4 platform when I trade Forex, but I do all my analysis on TradingView, which is for free. And I know that they also give free data on the Forex side for you guys that would be interested. You just have to basically sign up on tradingview.com and use their platform rather than, I'll show you guys a little bit later how to actually set everything up with the pitchforks and do your analysis there. identify the zones you want to trade, and then execute in the MetaTrader 4 platform. So in this case, again, using a shift pitchfork, we just used the 50% of the range to anchor our median line to. And as you can see, the angle of this ascent that we've had here is basically flatter. And you'll find a lot that when you are dealing with corrections, that your angle of your correction is way flatter than, for example, a trend would be, which could be really strongly upwards or downwards. So in this case here, I used the golly again. I used gold, and this was last year November sometime. And very easily again, we used at the low from where we believed a correction would have started from. We had a pullback at point A, and we got a higher low over here. And this was the first time we could start using a shift pitchfork. Because what we're trying to do is basically find the end of a correction. And I would recommend that you guys only use a shift pitchfork when you're dealing with corrections. And in this case, picture perfectly, the C wave after a single zigzag ended right at the upper median line and price went downwards. Everything here is still the same. Call this a center median line, an upper median line, a lower median line, and your upper warning and your lower warning lines. Here we had a lot of clues again that we're actually using the right pivots by simply looking at what price was doing when it interacted with our median lines. There we had our first clue. It respected the upper median line. It pulled down. It didn't actually break this low. It came down right to the lower median line, went upwards. It vibrated around the center median line. And now we had a great opportunity to figure out where this trend or this correction might end, and it ended up at the upper median line. In this case, we're just dealing with a simple ABC zigzag. Later on, I can probably show you some examples as when a more complex pattern that we look at is like a double zigzag, which is basically two ABCs joined by WX wave. And there are different ways that you can actually draw your pitchforks over these corrections if you knew what you were dealing with. Next slide. Guys, I'm just going over this quickly. We'll be delving into a lot of examples on live charts a little bit later on. But now is actually a very important part of this whole course is that I've developed is a set of entry conditions. And I'll be showing you a real example of a massive trade we took earlier this year, which was a picture-perfect setup. It doesn't get anything better than that, but I think I'll be using that as an example so that you guys can exactly see how everything comes together. Now, before I get into the entry conditions I look at, I basically want to see these entry conditions pop up after I confirmed or I identified a zone. Like, for example, in the previous slide, we looked at an ABC. If I were to think, for example, that an ABC might end up the upper median line in the previous slide, for example, I would then be waiting to see a certain set of entry conditions appear when price reaches that median line and interacts with it. That gives me a signal to take a trade. It forces you to be patient. It forces you to be disciplined. And this is probably the only sort of thing where I have real strong and hard and fast rules as to when I take an entry. So without further ado, my first entry conditions that I actually look for is a set of candlestick patterns. And then those for you that's been trading long enough, or that you don't really need to be trading like that long, you probably have seen that candlestick patterns play a very important role in trading. However, any one of these patterns that I'm going to show you in a little bit later, and especially the one that I follow, can pop up anywhere in the trend. My main thing is that I want to see them when they actually interact in an area where I think a trend might reverse. This is the first time I actually start looking at them. So firstly, when you identify the zone, like in the previous slide, for example, where I think a C wave might have ended, I would like to see these entry conditions pop up when price reaches that area for the first time. Otherwise, I don't even look at them. Okay. So we'll be looking at bullish or bearish engulfing candles, and you guys will probably recognize a lot of these things. And there are probably hundreds out of these in the world of trading. But I just follow a few of them just to simplify things. I just get confused if I have to also follow along with all these weird and wonderful names they sometimes call these candles. So the first one, like I said, is a bullish and a bearish engulfing candle. I'll show you examples a little bit later. Then I follow a hammer and inverted hammers. Candles I just call simply reversal candles. I don't know if there's another name for them. I just like to keep it simple. I call them reversal candles. And then another formation that I called flank dojis. All right, let's get to the first one. Very easy. Bullish and bearish engulfing candles. And again, I want to see this when price interacts at my upper or lower median lines or my upper or lower warning lines. Would happen when you actually have normally a period of indecision. Like in this case, for example, it could be a doji, it could be any sort of bar, but what you want to see is an actual bar that is short in range, followed by, in this case, a bullish momentum upwards, a long-ranging bar with a huge body that engulfs the previous candle. And when you actually look at the course, you'll see that I actually only look at these candles on a 5-minute time frame. This is the part where I actually tune down into lower time frames when I'm looking for my entry conditions as price approaches my upper or lower median lines or zones that I identified beforehand, so that you can actually limit your risk as much as possible. And once you see these sort of candles pop up, you'll move to the next step we will discuss a little bit later. In a bearish reversal, for example, we've had a similar thing. We had a candle here followed by a large bodied reversal candle, in this case going downwards, that engulfs the previous candle. It's very simple to spot these. They're probably one of the most common ones that you'll find at the end of corrections. But like I said, you can find these anyway. For me, it's just very important that you find these formations when they actually touch areas or zones that you identified where you expect a trend or a correction to actually reverse from. The second one we're going to have a look at is called your hammer or inverted hammer candles. Now, these guys appear a lot as well. And in the bullish instance, when you had a trend, let's, for example, on the left-hand side here, that's been moving downwards, and let's say you had a median line or sorry, a lower red warning line here or something like that, and you start seeing these candles. They call it a hammer candle because it's got a very tall, long wick on the bottom. Probably, I guess they called it that because it looks like a hammer, with a very little to no upper wick on the top of the body. So in this case, we had two here, and for me, it doesn't really matter if I'm seeing it as green or red. I just want to see them pop up. And later we'll be adding another filter that I want to see in conjunction with these before taking any trades. This was a bullish formation in this case, which would just be a hammer. And we'll normally see inverted hammers, which would be the opposite of a hammer, just the upside down, when you're actually going up into a high and then get a reversal lower. Now see, we've got a beautiful inverted hammer here. Now the body here could either be red or it could be green. It doesn't really matter. So that's a hammer and inverted hammer candles. Next one is what I simply call a reversal candlestick. A reversal candlestick has just got one rule for me. Yet again, I want to see this when it actually touches one of my median lines at a zone that I've identified beforehand. But what's very important is that the actual wick needs to be the lowest or the highest point in this case, in this whole continuous move up as it went into the area you want to trade at, followed by a tall wick with the body closing, in this case, as far down as possible, in this case, as far high as possible. There could always be, this could have been turned into a hammer as well, and I'll just call that a reversal candlestick too. But the important thing to note here for me is that that actual low, in this case, before price went upwards, needs to be the lowest point on, let's say, a reversal, in this case, the highest point when you're looking for a reversal after a bullish confirmation. Second up is what I call a flank doji. Yet again, it's just something I call it to make it easy for me to understand in my mind, and very easy to spot as well. And as I'll show you again in some examples a little bit later on, is that basically you want to see in a downtrend, when you get a reversal going higher, that you want to see a long ranging. In this case, we had a bar going down, followed by what we call a doji. Doji is basically a wick that went up and down, explored the price limits, and then had a very small body in the middle. It doesn't always have to be in the middle, but basically what this indicates is there's indecision in the market. In this case, we, on the right-hand side, we had a trend going up into a high. This is the thing. You won't always get these wicks to be the highest or lowest point in a reversal, but as long as you can spot them and they are flanked by, in this case, one going down, and immediately after you get your doji, a continuation in a different direction. Here we got a direction going upwards. Beautiful doji over here, closing at its lows. There's no body involved there, followed by an immediate downturn. So as long as you can visually start getting these patterns that I'm looking for from a candlestick perspective in your head and spotting them at areas that you think you want to be trading from, that already gives you a little edge. But like I said before, they're completely useless for me if I would just have to jump in and out of the market anywhere in a trend. I want to see these appear when they actually hit zones I identified before, in our case, at areas where it interacts with median lines of our pitchforks. This is the only part where I'll be using an indicator for the first time. And what I would like to spot in conjunction with reversal candlestick patterns is momentum divergence. Now, momentum divergence is basically just spotting that price action is doing one thing. I'll show you this in the next slide, but the momentum is actually driving or getting lesser as, or doing the opposite of what price is doing. We can go into a few settings a little bit later in the ones I use. It is all in the course. I give a really good explanation there of what settings to use. And it's called the MACD, which is a momentum average convergence divergence. And all I use is basically the histogram of that, indicated by blue bars. I mean, you can color this the way you want to, but I use blue bars in my analysis and throughout the course. So basically, we want to be spotting momentum slowing down into a high or low. Yet again, it needs to be an upper or low median line, or upper or lower warning lines, followed by your reversal candle bars. And then basically that's when you know momentum is diverting from price, and actual price action is probably getting ready to turn around. I'll give you a really good indication of what momentum divergence looks like. Yet again, this is a picture perfect example. And in this case, I'm going to be using the US dollar Canadian on a 5-minute chart. I also use the MACD on my 5-minute chart. Like I said before, the 5-minute chart is the entry time frame that I use, since we can really focus into market action, like looking at it under a microscope to see what price action is actually doing. And in this case, just as an example, you could see that what we call divergence, price has been moving down into a low quite strongly, yet we had a first indication that our momentum was drying up. If momentum was actually getting stronger and stronger, these bars would be getting longer and longer to the downside, but it was diverting or doing different, or was actually behaving differently from what price was doing, and showing you that momentum was driving. And what we have here, you could probably call this a reversal candlestick, or you could call it an engulfing candlestick. But like I said before, a reversal candlestick needs to make the utmost low. In this case, it looks like a double, but it's actually a tick lower than the previous one, followed by an upward move that closes high off the highs, or off the lows, sorry. And just go to the next slide. Why am I stuck? Oh, hang on one sec. Oh, there we go. To explain everything properly to you guys, I'm going to again stick to US dollar, Canadian dollar. And this is a picture perfect example that I want to show you. Things do not always set up picture perfectly, but when they do, you need to be ready to pull the trigger. I just want to be showing you in this example the real power of what the strategy is capable of when you actually have the patience and the commitment to wait for these sort of setups to happen. And I do think that if you guys are new to market geometry and you're new to the course, to please just stick with these rules and entry conditions. They are a little bit conservative. I'll later explain a little bit few things we do differently in the forecasting course, or the forecasting membership that we also offer, where we do a few things a little bit differently and why we actually do that. But I think if you want to be a self-directed trader and you want to be trading this strategy, just to stick to the rules and going over as many charts as you can historically and see if you can actually spot these sort of reversals yourself. Now, firsthand, this was an actual trade that we covered on the 15th of February this year. I'm using this example because it's probably the biggest trade that we took this year. It resulted in over 7,000 US dollars in profit. We had to have a lot of patience riding the whole thing out. And before we actually get to the results and how we done all the, how the entry happened, all that sort of stuff, I just want to make it really clear that in part 3, which is also the final part of this course, is that we'll be using pitchforks again in such a way that we can actually track a trend, or when a continuation after a correction happens, in such a way that we can safely trail our stops a fair distance behind our stops or our entry without getting stopped out, and how to also place your targets. It's a very powerful method to be using pitchforks to find the end of corrections, but they are just as powerful to use when you actually want to figure out how to trail your stops and where to place targets, etc. So this was an actual trade that I've posted to my members on the EPS forecast service. And we were looking here at a 30-minute chart. I know in the course I actually say 20-minute. It doesn't really matter. It's whatever your preference might be. And I simply took the highest high that the Canadian dollar had. And later on, I'll show you how I actually got to this. Took the highest high here with the lowest low that he made, and I just linked it up with a shift pitchfork to the lower high, and I identified a zone where I believe this correction might end. Now, this is something I also believe you guys should be doing, is rather identify a zone than, for example, just a level. And the reason being for that is because these angles of these median lines are sloping downwards. We don't know, price could go up from here and then go down again, which means by the time it does reach the lower median line, that the price would have changed, because price is actually sloping downwards. So it's always a good idea to identify an area or a zone that you would like to start seeing your entry conditions pop up with momentum divergence when price actually enters that zone. And in a lot of cases, a good habit would be to figure out where price is currently at, draw yourself a box where a zone is, say where that zone is, but by putting the numbers on there, and then put an alert above that zone so that you don't have to be stuck to your computers all the time. So for example, when your alert goes off, you know it's time to look at your screens for the first time. Otherwise, you might start doubting yourself. You're going to get nervous, all those sort of emotions that we really do not need to be successful traders. So in this example, just quickly again, on the 15th of February, I very easily and basically drew a shift pitchfork connecting the most important pivots. And I said, we're going to probably have a reversal here, hopefully. And let's look at the next slide. There we go. And this doesn't get better than this. You'll see as price came down into the zone, and now we switch to our 5-minute entry chart. You could see when price interact exactly with the lower median line and didn't even look back. It went straight up. We had momentum divergence between this low, price went up, and this low here. And quite often, this is a question I get asked quite a bit, is which actual pivots do you actually use to identify momentum divergence? Well, there's a few things you could do. For example, you want to see divergence between a previous low in this case, in this example, and this divergence here. It might not look like much of divergence on here, but this, because this is scrunched up quite a bit, if you would actually open this box quite a bit, it's actually angled quite a bit more. And what did we see when price touched for the first time? We had a bullish reversal, flank doji formation. And that basically said to you, listen, it's time to enter and to take the trade. So a quick recap, price came down into the zone you identified beforehand, and this is very important. You knew about this before. You weren't just there when things happened. You were prepared, and you knew exactly what you were waiting for and looking for when price actually interacted with your lower median line. And in this case, it doesn't get better than that. It touched to the pip, gave us a beautiful reversal confirmation, and also we had momentum diversion on the MACD, and price went upwards. Now, just to show you the actual entry that we used, in the course I mentioned that I like to go a couple of ticks. Again, this is probably confusing to some people that only trade Forex. In Forex, they always refer to pips. But I had to use ticks as a universal language because just to accommodate everyone, there's a lot of guys that do not trade Forex. Some people might be trading futures or CFDs or stocks, whatever it might be. And in my case, I said that basically I entered a couple of ticks, which was at 2455, which was where this reversal formation ended. And I went at 2457 was the actual entry. And I placed my stop loss slightly below there. Very importantly is that these entry conditions were developed, and especially looking at it in the 5-minute time frame, to keep your risk as small as possible and to find the best sweet spot where you can enter with the lowest amount of risk. And although this might look like a big stop, I can promise you when we look at the next slide of how things turned out, that the targets we were actually aiming for in this example were so large that it actually dwarfed the stop loss size that we were using here. When you look at the trade results that we actually post on the EPS forecast strategy, is that we use a 2% risk per trade. And as long as you know exactly where you want to be entering, you know exactly where your stop loss is, you then would know what sort of position size you'll be looking at when you actually enter the trade. We'll also be looking at where we're placing targets and those sort of things in part 3 of the course, and that I'll show you guys later. But you also know exactly beforehand where you want to be placing your targets. So there's no confusion when it comes time to pull the trigger. You know exactly what to do, and that's a very powerful thing, because what I try to do with my entry conditions is to remove the emotions that's associated with entering a trade. Okay, let's go to the next slide. And there's the actual results we had on this trade. Again, it's probably the best trade we had this entire year with the most picture perfect setup that you could ever ask for. And after this slide, I'll actually show you the entire strategy of how I was thinking, what I was looking at before taking the trade in just one slide. But as you can see here, our entry was at exactly the low of this correction. Original stop loss was down here. I'm going to explain to you guys how we're going to be using the pitchfork in part 3 of the EPS strategy to show you where to place targets and how to trail your stops properly. But in this case, we only had a 12 tick or 12 pip stop loss with a 542.8, if you want to count that, reward associated with that trade. In this case, we used 3 targets, and at each target I took 33% off. So your entire profit would probably not have been exactly going all the way from here to there, but regardless, it was a massive trade. If you took 33% off or 30% off at each of these targets, and you had started with a $10,000 account, you nearly doubled your account in one single trade. These kind of setups happen a lot. It's just you need to have the patience and obviously the experience to know what you're looking for and to actually wait for these things to set up. But they do happen quite a bit. I'll have to be dead honest with you. You don't always have your entry conditions firing off picture perfectly as this do. But in our today's training session, I wanted to show you guys why these entry conditions, together with the pitchforks, was developed in the first place, so that you can see what is possible when you actually do hit one of these massive trades. In this case, actually, this trade lasted for nearly a month. And this is also a very important part. A lot of traders are so used to taking losses that when they start seeing profits, they either take their profits too quickly just to see the market continue in the initial direction, or they trail their stop losses way too tight and get stopped out all the time. This is why part 3 will also be very important. I'm going to keep on nailing on that, because if you can use a system and a systematic approach like we do for finding end of a correction, we can also use that same approach to also trail our stop losses and set our targets at areas that make sense and at areas that are safe. So a beautiful trade that we had here in US dollar Canadian. We've got many more that happened on the EPS strategy this whole year. As you could probably see, we nearly quadrupled, or we actually quadrupled a $10,000 account already. So all these things happen all the time. It's just you need to have the patience, and you need to continue drawing pitchforks and continue practicing, going over your charts, your favorite markets, and see if you could actually figure out where these corrections would have ended. Obviously, this is in hindsight, but hindsight's only 20/20 vision that we have. The more you start going into corrections and trying to understand corrections and drawing your pitchforks and all those things correctly, the more sense things are going to make on the right-hand side of the screen, or the right-hand side hard edge that we trade, where we don't have the benefit of knowing what the future will do. The only thing that we can use in our example is like understanding what a correction might look like. And in this case, it was a huge ABC, a very ugly looking one. But like I said before, we didn't really need to label the ABC properly. We just had to use our pitchforks to guide us where we would think the correction would end. This is on a 240-minute chart, just to show a bit more of the historical price action and what led me to actually post this trade idea in the first place to our EPS forecast members. And as you see, this little low over here did not actually touch that red line, because on the 5-minute it was actually way off. It actually just touched there. It's just scrunched up now on a 240-minute, or 4-hour chart. Very simply, as a quick recap, we had a downward trend intermediate on a 4-hour, which is our parent or our main operating time frame. Price broke above that trend line. This is very simple stuff, guys, and it's also very powerful. I believe you don't really need to actually complicate things too much. Price also broke 2 areas of previous market structure. And then we used our Fibonacci extensions. And when price actually reached the 100%, we got our first massive correction downwards. Used our pitchfork, identified the zone before price even reached there. Looked at our entry conditions using our candle formations that we look at, and also spotted momentum divergence at that low, and we actually nailed the exact low and up we went. This is the power of the strategy. If you only take the time to really practice and practice and practice, I can't say this enough. In the beginning, you might be confused and you must like, oh, Elliott wave, and all these patterns and corrective stuff that you get. How am I going to label things properly? And all I can say to that is that the more you start focusing on market structure for what it is, pure price action, understanding how waves develop within corrections, and even if you're still confused, just use a pitchfork, for example, to guide you in your decisions. These sort of trades are definitely possible all the time. We're going to show you a few variations of what we do with the forecast members a little bit later on, also why we do that. Okay. So before we get to the actual question and answering session, things might seem like I've been rushing or all that. It is a slideshow, but I'm actually going to be diving into some real examples of recent trades that's actually been taken that we've forecasted in advance for our forecasting members. And regardless if you decide to sign up to become a forecaster, as we call them, it doesn't really matter. It's just that you'll see that the strategy works, and there can also be variations or a different approach if you do not have the time to be present when you actually need to be looking at your entry conditions, which is quite important. I mean, most of us probably have full day jobs, which means you can't be at the screen all the time. It's also perfectly safe just to place limit orders at around areas where you think you should enter. But there's also things to consider when you start doing that. So let me just go over a quick few recent trade calls and setups that we've actually given to our members. And for that, I'll need to switch to my desktop site. Where can we go on that one? Let's see if we put that up. Nope. Stop sharing. Just hang on with me, guys. I just want to get that screen going. Nope. Just hang on in there, guys. Let me just get screen 3. Does that pop up? Yes, there we go. All right. This is an actual trade that we were looking at. And this is where we're going to talk a little bit about variations of entering things. If you do not have time to be following entry conditions or actually be present when things set up. Also want to show you that you don't always have to be right at the end of a correction. You can even be late and still be right when a trend continues. One example, for example, is on the US dollar Chinese yuan currency pair on Forex, where we had, in this case, I already thought that an E wave in an ascending triangle already ended. And how we counted this, and this labeling was actually done after the fact, but I thought there was enough profit potential in this trade to still jump on board in case things do go our way. In this case, I already thought that we missed the E wave, but as an example, we had an A wave, B wave, C wave, D wave, and an E wave with a flat top. I marked this after the fact. We only start looking at things when we're around about here. And what I did was just to say, like, listen, if this was the end of an E wave, then this thing is going to continue. And where would I know that this thing is going to continue? Well, when it breaks above this upper horizontal trend line, which we placed the buy order at 6.8800. Price went upwards. And this was sort of the time when Mr. Trump already started having issues with the Chinese about imports and all that sort of stuff. And price actually went sideways for a while, quite a while, actually. We were talking here about almost a week. But this is the power of corrections, knowing that we had a high probability that the E wave ended. There was additional clues that I thought that the E wave ended, although we did miss the actual low. Is that between your A wave and your C wave and what we thought the E wave was at the time, the actual waves as we were making higher highs or higher lows, sorry, in this case, was already momentum between those waves were getting less and less and less when price came down. And this is the thing, guys. If you do not want to, for example, be following hard and fast rules of entering right at the end of a correction, you could even go as far as saying, like, I want to take a more of a conservative approach and actually let price confirm that that low is in this case, momentum started going upwards immediately after this low and after momentum divergence between these waves. And then if you were then to say, like, listen, which point will I be right if this was indeed the low? In this case, if price were to break above. It did break above, pulled back a little bit, and boom, off we went. And reached, in our case, we were trading this thing and we were unlucky to actually get stopped out after price reached our first target. These sort of corrections and volatility is obviously a result of political interference or whatever you want to call it. But either way, these things you cannot you cannot predict these sort of things. Although price actually went to target number 2, which was also actually the end of, almost very near to the end of this correction, the price has since been trading downwards again. I'll show you another example. This is another example of, looks very messy at the moment. A trade we took was on the pound US dollar. Without actually getting too confused here, I actually missed the end of this correction. Forget about actually looking at, let me just take that one away for you. By the time I start looking at this, we were here already somewhere around the 1.30500 level. And I drew my pitchforks and seen, oh my gosh, we've missed a beautiful entry down here. But, price didn't actually make it all the way to the high again. So we thought, okay, well, where can we find another entry? And in this case, we just go back to that previous one and remove this one. I use an upward sloping. We're going to cover this in part 3 of the course again. Price went upwards. This is now after I've seen that actually ended there. And I see that price was already started bouncing around, in this case, a 50% between the center median line and upper median line. And rather than actually taking that low there, I decided, well, this is a variation that we do in the forecasting for our members, is that if price actually could prove itself going upwards, then I would take a breakout trade over here with a high probability that it would at least take out this high. And in this case, he did. Unfortunately, pound US dollar had different ideas, and it only went to first target. Our upside target was way higher than that. It never reached there, but knowing how to trail our stop properly, we still made a half decent profit on this. Guys, I also need to show you that everything is not always the best examples. I also want to show you the bad examples, but even if things don't turn out the way you intended it to, you can still come away with profit without taking a big loss. In fact, when you actually look at our performance on the exponential profit system forecasting track record, we very rarely, I would say probably less than 10% of the time, take a full stop on our initial stop. We very quickly trail our stops and limit our risk. Like I said before in my previous part, is that the most important thing for any trader is to become an expert at managing your risk, and also not just entering a trade, but know how to manage an open trade, which is an exceptionally important part of a strategy as a whole. Let's quickly have, I think I've shown this one last time, and this is also just a really good example to show you guys, and this was on Boeing, which is a stock on the Dow Jones, where I was a little bit unclear as to, I knew we were dealing with a triangle. I think we start looking at this triangle around about here, and I wasn't sure which was the exact way to label this. And this will actually happen quite a lot. I mean, since we're dealing on the right-hand side of the screen, you don't really always know where's the most likely point for a wave to end. But if you use the steps and the techniques that I showed, in this case triangles, and you use your trend lines properly, and especially on triangles, your FIP retracement levels, you can stand a really good chance to identify an area where you can enter, and then also know where to place your stop in a safe manner, even if you weren't present at that low, or when price reached an area you wanted to trade it off from using your entry conditions. Because I know a lot of you guys are working, you don't always have time to be there all the time. I mean, some of these things could be setting up very late at night. For example, I live in South Africa. I also have a family. I have to go home. I can't be glued to the screens all day long. Otherwise, I'll have no life whatsoever. But there's no harm in placing a limit order, for example, that we did here for the forecasting members. But the risk of that you need to consider when you actually start doing this is that your actual stop losses will probably be larger because of that, which will then also reduce your reward as a result. But either way, once things actually do trigger and they go our direction, we're very quick to limit our risk. Like I said, it's less than 10% of the time since the beginning of this year that we actually take a full stop, which is also a very powerful thing to take note of. My next image is, for example, this is what happened. It went up to our second target, no problem. This was entered on a limit order. It actually entered here, went up, came down again, and this actually turned out to be our E wave. So for those members that actually decide to be a bit more conservative and to wait for the entry conditions to appear, they would have had the entry conditions pop up over here. But like I said again, if you do not have the time to be glued to the screens all the time, entering with a buy limit order is perfectly, in this case, a buy limit order is perfectly acceptable, as long as you can start identifying these patterns and know what to look for beforehand, which is perfectly explained in the course. And in this case, price went to our second target. We almost caught the exact high before things start collapsing downwards again. Just to give you a quick example, this is a trade we took in Apple. And the first time we looked at this was, I think, no, this was actually, yeah, this is in the beginning of October. I also missed the entry. This was a beautiful ABC pattern down, very simple, single zigzag. It was very easy to draw a shift pitchfork here. It ended right at the lower median line and price went upwards. Now, we only start looking at this thing after we thought the C wave was in. So here again, if you cannot be in front of your screens all the time and watch and wait for your entry conditions, then there are different ways to enter the market. Like I said, the risk of is that you're probably going to be using a little bit larger stops. But as long as you limit your risk according to the position size you're using from where your stops actually set, then you've got no issues whatsoever. In this case, price moved up, test the median line. It came down again, and at this stage, I said what we call a breakout trade. I said, like, price needs to prove itself, and if it does go over the center median line again and breaks this high or very close to this high, we'll probably have a continuation of the trend. So in this stage, rather than missing the entry here and saying, oh, but I missed it, and leaving Apple to do its own thing, you could have said, like, right, I missed the entry, but I can still try to continue or find an entry in case this thing does move higher. And in this case, a really good example again, price went straight up, and in our case, actually only made it up to 234 somewhere and came down again. We got stopped out around about the high Z on the trailing stop. Again, using our pitchforks to do that, which I'll show in part 3. Just to show you a little bit of a niggle, if you were to follow the entry conditions without, let me just open this a little bit. There's that Apple trade again. Let me just open that Apple trade. Where was it? There. If you were present here at the C wave and you were looking for this and you actually traded this low, there could have been a problem, because this is the actual C wave on that 5-minute chart when it hit the lower median line. Just hang on one second. We had one huge engulfing candle, which was obviously a great positive sign that this could be the end of the correction. But if you were sitting here and you followed the entry conditions to the T, then you might have missed this, because why? Let me just bring out my drawing tool quickly. We had no momentum divergence whatsoever. Price came down very, very strongly into that low with no momentum divergence. This is this is a great example that I need to tell you, is that although the entry conditions were there to filter out the good from the bad trades, there will be instances where you could miss a trade if you were strictly following those entry conditions. But rather than giving up, and let's say you were late to the trade, you could definitely enter up at higher levels, which probably be a bit more of a conservative sort of approach. But like I said, it all really depends on how strict you want to be, how conservative you want to be. Do you actually want to trade the actual low, which is going to offer you the lowest risk with the highest reward? Or do you want a little bit more of confirmation for things first before you enter at a later stage? So this is all up to you. I know there's been quite a few questions coming through the support channels from members that's been asking beforehand if they can actually trade by changing the time frames to suit their sort of like lifestyle or the time that they have to trade. Some guys want to do larger sort of swings. Some people want to do a bit more of day trading, etc. And the answer is yes. I'm always there on the support side to answer these questions, but please give me examples and share charts when you actually do want to ask questions. It's very difficult for me to go and find examples for you unless you actually done the homework to show me exactly what you're talking about. For example, I developed this trading strategy because I used to day trade quite a lot. And to be dead honest with you, I was mostly doing a little bit better than break even. I developed a strategy so I do not have to be glued to the screens all the time. And the time frames I'm using in the course are the ones that I use personally to free up some more time to prepare for a trade in advance, and then set alerts when price actually do reach my areas, and then I would actually go look for my entry conditions. If my entry conditions do not pop up there, then I won't say, like, for example, oh, I missed it and let it go. I'm always there to take on what the market's going to give me. things will never always be as picture perfect as what was, for example, on the US dollar Canadian trade that I showed you earlier on. But rather than giving up, there are different ways you can enter the market at a later stage when price actually confirms that it actually wants to go into your direction. And if you guys are interested in using lower time frames or even higher time frames for much larger swings, then you're always welcome to ask me or send me an email, and Casey and Nathan at support will forward that to me. But like I also said, I think when you're new to the strategy, there's a lot to take in. There's a lot of components to the strategy that all needs to work together to find these low risk sort of setups. And if you can actually follow the initial rules and stuff that's laid out in this course, especially your entry conditions when things appear around your zones or levels that you identified beforehand, then try to stick to those rules if you are unsure about waiting for price to go up and entering at higher levels, etc., etc. I've been trading this strategy for more than 4 years. It took me longer than that to develop and to fine tune my skills to actually make it work for me properly. I mean, the proof is all in our forecasting abilities and the EPS strategy results or performance. So it's just a matter of really putting all of this to practice and keep on practicing, keep on practicing, keep on practicing. And like I said, I'm here to answer any questions. This will not be something you're going to learn overnight. This is something that will take a while to figure out. The only subjective or part in this whole thing would be pitchforks. But for example, just even if you look at the 5 minute over here, the idea that we use the previous correct pivots in this pitchfork rather than using this one or using that one there at the B wave or using this one, there were enough clues beforehand to show you that you're probably on the right path. Let me just see if I can change this. No, that's a screenshot. But anyway, these setups happen all the time. But like I'm just trying to tell you guys, you won't always get picture perfect setups. But if they do happen, then you better make sure that you do take them. And this is exactly why this whole strategy has been developed, because I used to be a very nervous trader. I had a lot of indecision. I lost a lot of money along the way. And this is one of the only ways that I could pull in my own reins, like a racing horse I'm used to be, and know exactly what it is I want to do before it actually happens. And when I see things appear at the areas I want to trade the way I want to, I execute the trade. And that way, all my fear dissipated, all my indecision dissipated, and it made me a way better trader. And I'm sure it can definitely do the same for you guys. All right. I think that is probably it for today. I've showed some examples, went over a few things. I'm sure there's going to be a lot of questions coming from you guys, and this is probably the part I'm looking way forward to, so I can answer you in person. But before we get there and hand things quickly over back to Casey, like I said before, there's a part 3 that we're going to be doing in our training session, which probably be, I don't know, Casey, next week, Friday, or 2 weeks from now. We'll still have to confirm with you guys. But I do recommend that after today's session, that you guys start getting questions together as much as you can. There's nothing that you, or something you do not understand or did not think of during today's session, to write them down and start sending that through emails. I don't care if we have 100 emails. Just start sending them through so that I can help you guys on with a personal touch. So last thing before I hand things back to Casey, in part 3, yet again, we're going to go into a very important part, although it's just 2 bullet points here. We're going to be talking about trade management techniques. Very important, guys. One thing to find an entry, it's another thing to actually maximize your profits properly. And it's a difficult thing to do. I won't lie, but if you have a systematic approach, like we did, for example, finding the end of corrections, then we can use the same systematic approach using market geometry and a few other techniques to actually show you where to place your targets and how to trail your stops properly. And there we go. I think that concludes my part for now. I'm going to hand things over to Casey. If there's anything I didn't cover, like, please, guys, just please ask me. I don't want this to go on for too long. It's just too much information. But yeah, I'm just going to hand things over to Casey, and I think that should be it.
All right. Well, thanks, Richard.
Oh, let me just get rid of this quickly. Cancel.
Well, we got some great questions ahead. So everyone that's asking questions, thank you. We will get to those in a minute, but I wanted to talk a little bit about the forecast, which is the signals directly to your inbox. And so immediately after this, we'll go right back to the questions. We got some good ones for Richard coming up. So the way the forecast works is you can get paid just by reading your email. And that's a little, it seems a little crazy, but it's actually true. And I'll show you exactly how that works for me. But really, it gives you the ability to scale, right? And that's the real advantage to trading that a lot of people don't realize. They think, okay, well, I can just make some money doing some trades on the side. And that's very true. But there's a hidden opportunity here, and that's scaling using the power of compounding your profits, which is really amazing. And I'm going to show you just a minute how you can use the forecast to do that. So growth is the secret. Because you can exponentially grow your account by increasing your size and keeping your risk very tight. However, meanwhile, if you're trying to do like the buy and hold technique, it could take 50 years to do that. And to be quite honest, not a lot of people have that kind of time. So this is basically the same type of strategy for growth, only it's accelerated and it keeps the risk low. So we're going to show you exactly what you get when you join up for the signals, what we call our forecast. So here's an example of how fast this can grow your account. We're going to take a look at 12 example trades. And these are just samples, but I'm also going to show you guys some of the real trades as well. It's really interesting. Richard was talking about some of those trades that we'd taken. I'm actually using this. And it's been such a fantastic blessing for me to be able to work with Richard because he is doing all of the hard work for me. And so thanks, Richard. And all I have to do is open my email. So it's really amazing opportunity for me, and I want to share that with you. So we're going to look at just an example of how this can grow your account. So this is 12 trades, and we wanted to break it down to show you exactly how this could potentially work. But the first trade would be a winner, right? And it's a 250% ROI. And remember, all of these trades we're risking $500. We're going to keep our risk consistent here. So the first one is it's a 250% IRR. So you're risking 500 to make 1250. All right. And then the next trade would be a loss. Then the third trade is a loss. And remember, it's $500. The fourth trade, we're going to risk 500. However, this time we're making 2,000, which is a 400% return on investment. The fifth trade is a loss. Sixth trade is a loss. Seventh trade is a loss. Eighth trade, we finally got a win. So that was a big losing streak in there, right? And this one is a nice winner, not massive. We risk 500, but we make 625. It's not the biggest win in the world, but it works. And then trade 9. Another $500 loss. And then trade 10, a $500 loss. Trade 11, a really big winner, right? And we showed you that USD CAD trade earlier that Richard took that was a massive winner. We get trades like that. So this one's a big one, 875%, making $4,375 with just a $500 risk. So I think you can try to figure out how this will work for you. And then trade 12 was a loser. So if we look at that, this is actually a profitable system with a lot of losing trades. And And so the previous example is a conservative example of the EPS trade forecasts. In this case, we lost 8 out of 12 trades, and our winners weren't as big on average as what we are targeting. Yet the small risk of just $500 generated a net profit of $4,250 over those 12 trades. So with a very poor win rate, but because of the targeting, there's still a really nice profit of $4,250. And that's just a sample. Yes, sir.
If you can hear me.
Yeah.
This is one thing people do need to understand is like any strategy will definitely go through a drawdown period. I think we're standing at the moment at around 70% win rate. There was, I think, when was it? Was it in April, May, or something like that? We had quite a few losers. This is probably the example that you're using at the moment. But like what members need to obviously keep in mind is that as long as your profit targets way out, dwarfs basically the amount you're risking, and it won't always just be a $500 that you're actually risking on. I mean, it depends on what size of your account it would be, but then you're definitely on the right track. This strategy, I think we could even, which is now doing about 70% win ratio at the moment, even if it was performing at about a 35%, I worked out the other day, we would still be making money. But we are on about double that. So it just shows how powerful things can get. Back to you.
Right. Thanks. And I appreciate that. And that is actually why with this example, I used it as conservative, because to be honest, it would be a little bit crazy if we showed out some of our really good numbers. So I wanted to keep it really conservative because, like you said, we go through drawdowns. And even in that example that I used, I went through, there was like a 4-trade losing streak. But what's really cool is you do have the periods of drawdown, but you also have the periods when you get on a roll and you win 3 or 4 in a row. And then that's when you can really see the growth. And when I'm going to show our chart, and you're going to be able to see that here in a minute. So the one other really great things is this is a reality for me, in that it's in as little as 20 minutes a day. That's not an exaggeration. This is real life for me. And I'm going to show you exactly what I do, because I'm not the trader. I'm the busy guy. I'm more like you. Richard is the guy that's putting in all the hard work. But so think about it, enough profit to generate a side income of potentially, it's not saying you're guaranteed, but a potentially, depending on what your risk is, of $50,000 per year with a $500 risk standard, even when only winning 33% of the time. And so again, this is another example of the power being able to compound those returns. So it would be totally worth it to join the signals and the forecasts if we did a side income of $50,000 a month. However, when you are compounding, it is really has massive potential. And so the power is coming from compounding your gains month over month. When you take just a portion of your net profit and you increase your volume, the results are massive. So let me give you an example of how that would work. So if you grow your risk from $500 to $1,000 per trade, your now potential profit is $8,500. And then next month you could afford to risk $2,500, then your profit is $25,000. And so on and so on. You just keep increasing your risk, and your trades could be growing and growing to where you could be risking up to $12,000 per trade, and your profit could be $102,000, which is the power of compounding. And that is how you become a 6-figure trader, which maybe some of you, that's your goal. Maybe some of it, you just want the side income, but you get to determine what that is for you. So making triple-digit returns is easy as opening your email and following along. Now, certainly not every month is going to be the same win or loss ratio with the same amount of trades and the same ROI. The markets are different. Richard will pick up different trades. We can never know what's going to happen. So this is just examples. But the potential to make extremely high profit trades that grow your account quickly is yours for the taking. Here's the chart of what we've done. And this is not quite updated, but you can see we have some really strong moves up here. And then we have a sideways period and then another strong move up. The good thing about the strong moves up is from those big ROI winners. Like you can see the USD CAD trade is right up here on 3.9. That was a big one. That was huge reward to very little risk. And those are the kind of trades, they don't come often, but when you can find them and get advantage of them, those are the ones that will really allow you to compound and grow your account. And so here's just some averages where we're at in just 10 months. And again, Richard had updated this. He said it's a little bit higher than this right now because this is an older number. But we're at a 410% ROI in just 10 months on an average of $500 risk per trade. $554 is the risk. So you can see the potential here. And this is the actual trades that we have sent through email through our service. This is the trades that the Forecast members are getting. So here's how I personally use it. I mentioned earlier that I was the one that am taking advantage of this. I got a lot of things going on in my life. I own 5 businesses, no joke. I'm a podcast host. I have 9 kids, and I trade and I travel a lot. So I don't have a ton of time available for day trading. It's just not there. So here's my step-by-step process on how I use the forecasts. So the first thing is I go to my email, right? And you can see I just go into my email and I search Richard K. And it comes up, Richard K., and all of my emails come through. And so here's the one that just came through yesterday, and it said, Richard K., forecast updated. And I click in. So right there, however long it takes me to log into my email, it's about 2 minutes, and I find Richard K. I'm right there. So then the next step is inside that email, there's a link to the dashboard. And this is what we call the EPS Trade Forecast Dashboard, really nice and clean laid out. It has all of the trade ideas, and Richard gives specific entries, exits. He also gives a summary about the trade and what he's thinking. So I get all that, and I read through it, and it probably takes about 10 minutes to really read it and understand it and just make sure that I'm trying to understand what he's trying to do. And he uses everything exactly as it is in the course. Right. So that's the next step. So then the follow step after that is step 3. I go to my trading platform and I place the order. I will go to the chart, and Richard always has an entry order. So I'll put my entry order, I'll place my stop loss, I'll place my target. I do it exactly as Richard says. And again, that probably takes another 5 minutes or so to place the orders once I've read through the material, and that's about it. It's a pretty simple process. It doesn't take a lot of time, and it actually gets me really excited every day looking for my emails. And the new trades happen on Tuesdays and Thursdays. There's 2 trade setups a week, and then the other emails are just updates on how we're managing the trade, because every time Richard moves a stop loss or starts to take profit or does any of those things, he will tell us so we can follow it along. And it's actually pretty easy to follow along. It might take a little time to get used to, but it's pretty simple. And so again, we're going to get to those questions in a minute, but I'm just going to share you the special offer on what exactly it is you get so you understand. So you get the forecast delivered directly to your email, and each report will contain timely updates on past trades and management of current trades. And each report will include some notes on current events to help you prepare for the week of trading ahead. And most importantly, each report will consist of Richard's personal trade forecast covering his exact plans on how to trade the setup with entry target, exit targets, and a management plan. So the EPS forecast reports for a full year that each report has the potential to make you thousands of dollars in net profit. So that's a full year, and every single report that you get has a lot of potential to make profit. So the normal price for this is $4,997 for one full year of forecasts. If you have the potential to make $50,000 in revenue, risking $500 per trade, then yes, it's obviously worth $4,997 a year. So today, because you're a member, you get a special member's price for $997 for 1 year, or we just threw a special offer we've never offered before, which is 2 years for $14.97, which is the best value. It's actually an $8,503 off. So it's a really great value there on 2 years, and we've never offered that before. And I was just thinking about the trades that Richard has taken, and like he was sharing that Apple trade. That trade was fantastic for me. It was a great trade. The Boeing trade was amazing for me. I took a really fantastic USD Mexican trade. So these trades have really been beneficial. So what you do is just click the link or the button to get started. There will be 2 price points on the sales page, the 1 year or the 2 year special offer. And you can go ahead and grab that link in the chat. It'll be posted there. Our support person will be posting that link in the chat right now. And in just one more minute, we'll be getting to the questions. So I can see a lot of them are coming in. I just wanted to share one last thing with you guys. And that is our triple guarantee. Our triple guarantee is that you'll see triple digit trade forecasts consistently, or you can request a full refund. Multiple 200%, 500%, and even 1,000% winners, or you can get a full refund. My team and I will help you take advantage of these trades, or you can get a full refund. We're really committed to making sure you guys are getting access to this. We've developed it in such a way that you guys can really take advantage. So all the risk is on us. All the work is on us. All you have to do is execute. Which executing is not easy, but the execution is on you. We give you every opportunity to do it, and it's really doesn't take a whole lot of time. So again, one last time, just letting you know about the price. It's $997 member special, or $14.97 for 2 years. First time we've ever offered that price point. And now, with that being said, go ahead and click the link to get started. You'll be able to see both price pages on the page. You'll be able to see the button below. Go ahead and get started. And now we're going to go ahead and do some questions here for Richard. So, Richard, you ready?
I'm ready. Shoot.
All right. Okay, so the first thing I just want to say is Nicholas said, Richard, you're an excellent trainer. Alan said, agreed, really good stuff. And I also agree. Also, this is fantastic. So thank you so much for the training.
Thanks, guys.
Okay, so the question is, Harvinder asks, what are Richard's pitchfork settings in TradingView? The hardest part for me is to draw the pitchforks as the training material shows. Thank you.
Okay. It's Harvinder, am I right?
Yes, Harvinder.
Okay. I'm probably going to hear your voice, but can I switch to my actual screen?
Sure, let me turn mine off here. Stop, and you should be able to take over there.
Okay. Can you see that?
Yes.
Okay, let's pull up any chart. Let's go, it doesn't have to be a specific time frame. Let's just go 4 hours, take my indicators off. And let's use TradingView. So first thing we have is our navigation bar here on the left hand side. The way I've done it is we actually have a shift pitchfork here or pitchfork here. That's a standard shift, and that's a modified shift pitchforks, which I don't use. We only use these two. I just use basically pitchfork, and if you want to get set up, you're going to click somewhere, click somewhere, click somewhere. All right. Now we're going to get into the settings. You'll see that this little box pops up on the top. 2 ways you can do this. You can either right click anywhere on one of these lines. You can go to settings, or you click on it. It brings up this little floating bar display thing here. Click on settings. Now, I don't know if you have the ability to take a screenshot of this, but This is actually the lines that I use. Your 1 would be your center median line, which I use blue. Then we have a 50%, which is actually between, I think this is your upper median line, and this dotted one over here, which is on 0.5. Blue again. I made it quite thick, and then I use the dash line. You see, you can make it or dash line. Oh, if you use it 0.5, it actually pulls in a 0.5 above and below the center median line, which is quite cool. Then if you want to get your equidistant upper red warning line and lower red warning line, you just go 1.5, like I did over here. And let's see which one that is. That's your centers over here. And if you go double, which is that over there, it's your warning lines. If you guys want to, I can take an actual screenshot of this, and we can actually send it out to the members if that makes it easier for you.
I think what we can do, Richard, is we'll just pull this little video clip, and we'll just make this a separate video and put it in the members area. Great question.
So what I basically do is I've got mine set on shift permanently. So every time I use just my pitchfork, is going to draw me a shift. Now, if you wanted to, for some reason, change it to a standard, click on it, or right-click on it, go to Settings, and there under Style, you have Original, which is basically their standard, and the shift over there to swing between. Automatically pivots. Okay, I hope that answers your question. If there's
Excellent.
any other issues, then yeah, please go ahead and just ask me.
All right. Well, guys, if you have any more questions, please type them in. In the meantime, I'm going to ask Richard the next question, but keep those questions coming. We'll be here to answer anything that you guys might have questions about, or even about the forecasting service if you have any questions about that also. So someone named Lighthouse, that must be their code name. Lighthouse is wondering if you only use the pitchfork on the ABC corrections.
No. ABCs are basically, let me just bring up my auto here. Let's give you another example. Pitchforks will only be, if you put it that way, ABCs, if you use it over correction other than a triangle correction, I'll be using pitchforks always. But when you get to your triangle corrections, we don't use pitchforks whatsoever. We're just going to use Fibonacci retracements and then those colored trend lines that you've seen before. Now, obviously, if you have a clue of what correction you might be dealing with, an ABC could become a double ABC or a double zigzag. And I mean, in the course, I think I do show there that if, for example, a single zigzag turns into a double zigzag, there's no harm in only using a pitchfork over the second zigzag to figure out where the second zigzag or the actual complete double zigzag would end. There are examples in the course for that. But yet again, if there's any examples you're unsure of, please bring up your charts and send it to support, and I'll be happy to help you out.
Yeah, I think that's a great point. I know you've mentioned it. I just want to say it again, just so everybody's clear. Guys, if you have really questions, the best thing you can do to get an understanding to help Richard understand how to help you is to send images of your charts and what you're looking at. So whenever you are having those questions about the system, please send in a chart, and Richard will be glad to help. We have another question here, Richard. And yes, sure. This is from Charks, and Charks is asking, do you recommend using spread betting and or a CFD account, for example, and also risking $500 per trade?
Sharks, good question. I know that the guys in the UK call it spread betting. To be honest, we don't have spread betting in South Africa. I think it's actually So we're not allowed to trade that. I know the guys in America, again, can't trade CFDs, for example. I do actually like trading CFDs because I do have access to them. Especially, I also have a futures account, I have a Forex account, and a CFD account. So it's almost like I'm with 3 brokers, so I have a really good mix of not keeping my money all in one pot, but also having access to a lot of markets, not just from a perspective of, let's say, for example, I'm looking at crude oil. If I were to trade a futures account, and I have to use, let's say I've got one massive reversal bar at an area I want to trade on a futures account, the risk might be too large for me to safely place my stop below that reversal bar. So in that case, I could be looking at the CFD, which would obviously, CFD, we will have US oil, for example, which is a CFD, tracking the price of crude oil on the future side. But what's nice about a CFD then is that I can control the amount of position I want to take and my risk with that as well. So it's really a choice between, what do you have access to trade? I know different countries can offer different things and some can't, but I always recommend you get a broker that can offer you as many things as possible so you can actually, participate in as many trades as you want to. Also, the $500 risk set amount that you were talking about, Casey, it could either be done like that, but it depends on what size account you have. I mean, a lot of people might, only have $1,000 or $250 account. If you have a very small account, then you'll probably be forced to only trade CFDs or Forex, for example. But either way, if you're only risking a certain percentage of the distance of where you place your stop, that will figure out the position size you're supposed to be taking. And it's really a personal choice as to how much you're actually going to risk yourself. I hope that answers your question, Charles.
Thanks, Richard. So
sure.
guys, go ahead and keep those questions coming. Anything about the course, any questions about that or about the forecast or anything like that, just keep them coming. I actually have a comment, Richard, and maybe it's a comment and a question.
Okay.
For my personal experience, I took a crude oil trade that you took the other day. Mm-hmm. And what had happened was, as soon as I took the trade, I took it out of a Forex account. Yeah. And I noticed that I had got a ton of swap on the trade, and it was really heavy, and it actually took away a ton of the profit.
Yeah.
And so that's something that people don't think about, because I know I didn't. And so we kind of need to try to find platforms that don't eat us up with swap and commissions.
Yeah. I'm not introducing broker to anyone. I think a very important part of actually before you start trading is to find a decent broker. I mean, swaps, brokers can be crooks. They can widen the spreads without notice. I think it's always better to find someone that's got experience with a broker first, or do your research. Is a very important part of actually trading. You need to find a decent broker that's not going to be cheating you. On the CFD side, I mean, I know you're not allowed to trade CFDs in the States, for example, but give you a good example here in South Africa. I've probably been through 3-4 brokers with exactly the same thing until I've actually, found one that this doesn't happen with. But, that is out of our hands, to be dead honest. And it's really just a broker issue. Them not being fair enough, for them widening their spreads at moment's notice, or price maybe moving too fast when you're getting in, all these things you got to consider when you're trading. It's unfortunately part of the game.
Yeah, that's very true. Richard, now in your course, do you use pivot points, and can you expand on how you identify those?
Basically, pivots to me is basically to swing high or swing low. Like I said, we use a systematic approach where I use a parent chart, or my main chart is a 4-hour. And then I'm going to be looking at that chart alone until I actually confirmed a correction appearing. Correction, like we said, will probably be happening around about a FIP extension somewhere. And knowing that a correction is underway is actually described in the course. But just to simplify it, is that, let's say, for example, a market's been trending upwards. And let's say, for example, it hit a 1.618% FIB retracement and price moved opposite direction on a 4-hour chart, downwards in this case, in this example. It went up higher, made a higher high, lower high. It did not break the start from where the correction happened and then moves downwards. Then you know those are the pivots you're supposed to be using. In the beginning, it's very important just to visually look at corrections on a chart and trying to figure out which pivots to use, or actually where's your lower high, higher lows, depending on which direction you're trading in. And then just use your pitchforks over that. And just keep on drawing until it comes out of your ears. And pivots, I know there's a lot of guys going into pivots. It's a whole study on its own. For me, I like naked price action. Obviously, ways to define trends and then using pitchforks, all that stuff. So it's a little bit different way to look at price action. But the pivot to me is basically an important high or low from where correction started and from where correction failed to continue the trend and be, areas where correction might end. So important previous swings in the market is basically all I consider to be pivots. I hope I answered that question properly.
That was great. So there's a forecast question, which I'm going to go ahead and handle that one. There's actually 5 forecast emails a week, and 2 of the emails will contain new setups, and the other ones are updates on those setups. On if Richard's moving a stop loss or he has a change in the trade idea, he'll update you on that trade. So you're actually going to be getting 5 emails per week.
Correct. Yes.
Okay, well, I think that's it for the questions. I'm going to give people one last chance because we've already been going a long time, a lot to take in. We're going to cut this up and put the actual training portion into the members area so you guys can take a look at that and just take it all in. But also, while you're watching it and reviewing it, you can always write down your questions and send them in to support. And we've got a nice frequently asked questions section, and Richard's always there to help out. And so I think that's it. I went ahead and posted the link again for the webinar special. This is a really tremendous deal, especially the 2-year deal. Fantastic opportunity to get trade updates for all this time. Thank you so much for attending today. Thank you so much, Richard, for the great training. Really appreciate it.
Thank you very much.
All right. Bye.
Awesome. Take care. Bye-bye.